Welcome back. It's important to explain that capital structure does not matter in a perfect capital market before we get to the real world, which is the imperfect capital market. The closer your firm is to a perfect capital market, the less it matters. And this is what this set of slides and this video and the chapter is all about. Now, we're going to start with our perfect capital market, Modigliani-Miller. No taxes, no transaction costs, no disagreement, competitive markets. And I'm going to also start with something we did in chapter 6 already. Later on in this chapter, we're going to relax this. We're going to make it risk neutral. That means every investment has the same expected rate of return. And just for illustration, we're going to presume that the time value of money is 20%. This is a perfect capital market, is risk neutral, so there's no problem with this. Here's the refresher. We're going to have as firm value probability 1/4, it's going to be worth only $60. Probability 3/4, it's going to be worth $100. And that can be anything. Can be a building, can be firm value, whatever. This is just for simplification. Now, what we want to ask is, what interest rate must you promise to raise $70 in debt today? So $70 is not the promise itself, it's what you need. In a perfect capital market, the debt will be due in 1 year, the firm will be sold, can be repurchased by you again at that moment if you want. There's no liquidity, there's no value, there's none of these other issues. And recall the expected rate of return on everything is $20. So here it is. Here's our little table. And we want to consider two different capital structures. One is all equity, the other is debt and equity. And just to remind you, I'm going to show you the little payoff table that we had in chapter 6. So we have capital structure scheme 1, which is 100% equity, and scheme 2, which consists of 2 securities, which is a bond that promises a particular amount of money that we will have to figure out, and the levered equity, the remainder after the bond is paid. And on the left side, I've given you the probabilities as a reminder. Good is 3/4, bad is 1/4. The expected pay and the price today. Now, what I want you to do is fill in all these different boxes. So here again is this sheet. Figure out what it is that you already know and put that in.
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, so what do we know? We know that if it's good, it will be worth $100. We know if it's bad, it will be worth $60. We know that the cost of capital is going to be 20% no matter what the security is. And we know one more thing. We know $70 is how much money we have to raise from our creditors. Now, think about this. What else can you calculate at this point in the set of what we need? So we ultimately want this, we want this, we want this, 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 this.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, there's 2 things that I could calculate here. The first one is this number here. How could I calculate that? Well, I knew that the expected amount was 3/4 times 100 plus 1/4 times 60. That gave me the 90. As something else I could calculate, I had the 70 here and I had the 20 here. So those 2 together allowed me to calculate this. Now, given that I have this, what else can I calculate?
Please pause this video now, answer the question on a piece of paper, and then continue.
So now there are 2 things we can calculate and add to this. Actually, there's already more, but I'm going to do the following 2 things. The first one is the $75 here. And I know this because I'm just discounting the expected amount of $90 by 20%. That gives me this number. Now I have another number that I can put here, which is this number here. And for that, I have to use a little bit of economics. And the economics is the following. I know that my expected pay is going to be $84. I also know that in the bad state, I'm not going to make it. I'm not going to have anything close to $84. So I know that at this point, this bond is going to get the entire rest of the firm. Okay, what else can we fill in now?
Please pause this video now, answer the question on a piece of paper, and then continue.
The next things that we can fill in are just the things on the very far right here, which is all of this. Because I know that in the bad state, the firm has to be equal to the sum of debt and equity. The same thing is true with expected values. 84 plus $6 is $90. And the same is true for the price today. The price today has to be the same. Okay, what's the next step that we can do?
Please pause this video now, answer the question on a piece of paper, and then continue.
The next step is going to be this number here. This comes from the fact that I'm going to get this 1/4 of the time. This I'm going to get 3/4 of the time. And this here is what it has to come out to. So this is the formula that I will need to solve. And you solve this and out comes $92. Okay, we're almost done. One more thing missing.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, this is also one of the easiest things, so we just need to add this and out comes $100. Okay, so this is our capital structure that we had worked out in Chapter 6. This was just a reminder. We can also calculate the rate of return on the firm, debt, and equity in the good states and in the bad states. So we've done this before. If you work this out, you would have to invest for the scheme 1, where it's all equity finance. You would invest $75. You either get 60 or you get 100. So if you calculate that, in the good state, you increase your investment by 33%. In the bad state, you lose 20%. And that will come to 20% because in this world, everything has to provide an expected rate of return of 20%. You can do the same calculations also with the other two. So in particular, what's easy here is for the levered equity, because we invest $5. In the bad state, we get absolutely nothing. So that's minus 100%. In the good state, we get 8. So therefore, we get plus 60%. The leverage ratio is the amount that is debt today, which in this capital structure that we're looking at right now is only this part. The debt is this, the equity is that. Therefore, our leverage ratio is 70 divided by $75, or 93%. So we use the perfect capital market whenever we invoked the additivity of the fact that bond plus equity is the value of the firm. So whenever we took the scheme 2, those two columns, the value over here, and added them up, we got the values over here. Now, in a perfect capital market, if the value of the firm was $76, under the debt-laden capital structure, say it was 70 plus 6 instead of 70 plus 5, but a manager chose the $75 capital structure, what would you do?
Please pause this video now, answer the question on a piece of paper, and then continue.
You would buy the firm at $75, that's what it was trading for. You would sell the debt-laden capital structure at $76, that would mean you would have an arbitrage of $1 immediately. No risk, no nothing. Therefore, the firm just would have to be worth $76 under any capital structure, because there's many arbitrageurs around like you that would instantly bid up the price 75.50, 75.70, 75.90 until it was just an epsilon different, so that there is no arbitrage there in the real world anymore. So it would always be $76. There is no difference in the ultimate price depending on capital structure. It's got to be the same number. What about the opposite? In a perfect capital market, if the value of the firm was $74 under the debt-laden capital structure, and the manager chose this bad capital structure, what would you do?
Please pause this video now, answer the question on a piece of paper, and then continue.
Same thing, you buy the firm's debt and equity at whatever the lower valued capital structure is. You would repackage the security and sell the firms in this security, in this case as a whole, at $75, and you would again win arbitrage profits of $1. So again, this is just not a situation that's viable in competitive perfect markets. Does the value of the firm depend on the value of debt and equity?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, it doesn't depend on the debt-equity arrangement. It is always the sum of the two. So the firm does depend on the value of debt and equity. In fact, it has to be the same. Always has to be the same. Which share of debt and equity maximizes firm value?
Please pause this video now, answer the question on a piece of paper, and then continue.
You cannot increase the value of this firm by having a different ratio of debt to equity under the Modigliani-Miller perfect capital markets assumption. Now, is this a general insight? Well, one problem is that the world is not anywhere near risk neutral. So one question that we have to ask is, does this still work with risk aversion? Or does it only work in this risk neutral case? And in this case, how does leverage influence the cost of capital? And that's really the most important part of the rest of these slides. So, same example as before. Perfect capital markets. Probability 1/4 worth 60. Probability 3/4 worth 100. But now the world is no longer risk neutral. The cost of capital for the risky firm overall is 20%. But that's not true for the debt and the equity. This is what we used before. Now we're going to ask our investment banker to raise $65 in debt. And our investment banker tells us that when he or she went over to the investors, they told him or her that we must promise the investors a rate of return of 16.92%. Otherwise, they won't give us any money. So here is the numbers that you were given. We have, as before, 160. We know the overall cost of capital of the firm is 20%. We also know that we want to raise $65 today, and that we have been told by our investment banker what the particular interest rate needs to be. So the 16.9% means $76. Those are the numbers that were given. Now ask yourself, what else do we know? What else can we fill in?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, the first number that we know is this 90. It's actually the same number as we had before. What else can we fill in?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, we just need to work down. That comes from the 90 discounted at 20%. That's $75. In fact, that hasn't changed in the example. That's still the same as in the example before. What else?
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, one of the things that I know is I'm promising $76, and I can pay that in the upstate. In the downstate, however, I don't have that much money. So I know that the most this can be is $60, which also allows me to immediately go further and know that equity is not getting anything here. What else?
Please pause this video now. Answer the question on a piece of paper and then continue.
Okay, now I have the 76, 3/4. I have the 60, 1/4. So 3/4 times 76 plus 1/4 times 60 is 72. The calculation is also here. What else?
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, if I know that I'm expected to pay $72 and this is going to get me $65 today, I know that the expected rate of return is 10.77%. What else?
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, the rest is actually fairly simple. So I've got those numbers here. They just have to add up to the same thing. So 72 plus 18 is 90. I've got 24, 0, 18, and 10. This only means that I have to calculate the expected rate of return. How much is that?
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, that's not very difficult. That's the $18 on a payment of $10, 80%. What is your cost of capital on the debt?
Please pause this video now. Answer the question on a piece of paper and then continue.
Pause. The cost of capital on your debt is the 10.77% here. If you go back, you will see that your cost of capital on the debt, which is the expected rate of return on the debt, was 10.77%. Debt is safer than the firm overall. Remember, the firm had a cost of capital of 20%, so its cost of capital is lower. What is your cost of capital on equity?
Please pause this video now. Answer the question on a piece of paper and then continue.
$80. The equity is riskier than the firm, so its cost of capital of 80% is higher than the 20% on the firm, and of course much higher than the 10.77% on the debt. Now, in the second scheme, what is the leverage ratio today? So not the 100% equity. What is the leverage ratio today? Go back to the previous slides and look it up.
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, you have $65 in debt, you have $10 in equity, so your leverage ratio here is about 87%. A very common number that people are computing for companies is the WACC, the weighted average cost of capital. What that is you take the weight that you have in debt and multiply it by the cost of capital on the debt, and you take the weight in equity multiplied by the cost of capital of the equity. So if you want to calculate that, what is the WACC in the second debt equity chosen capital structure?
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, we just calculated the leverage ratio, which was 86.67%. So 86.67% is financed by 10.77% debt. The remaining 13.33% is financed by 80% cost of capital equity. The weighted average cost of capital is 20%. So, the weighted average cost of capital has not changed. You can think of the capital structure in Scheme 1 as the equivalent of an epsilon debt, a tiny, tiny amount of debt, and 99.9999% equity. Now, the expected rate of return on this debt would be the risk-free rate. So that would be the smallest number that you usually can think of. And the expected rate of return on this equity would still be just about 20% plus a super tiny amount of money. The weight on debt would be about zero, and the cost of capital there would therefore be also around zero. Now, how does the risk and the cost of capital of the debt depend on the firm's leverage ratio? That is, if the firm now decided not to finance itself with 100% equity, but it decided to finance itself with a little bit more debt, or maybe more debt relative to what we had before, does the cost of capital of the debt and the risk on the debt go up or go down? Now, if it's not intuitive to you, go back and rework the example. Just increase the number on the debt a little bit, like you want to promise a little bit more debt.
Please pause this video now, answer the question on a piece of paper, and then continue.
Both the risk and the cost of capital of debt will go up. Now, in the big example that we had in the beginning a capital structure that was basically almost no debt. The debt was risk-free. There was almost no risk associated with it. Then we had a capital structure that was 85% or so debt. And what we saw is, well, yeah, this one can actually default. You may not get all the money that you were promised. And as a result, you had like 10.77%, less than the 20%. That is true, but that was far riskier, but more than the 0% or the risk-free rate that you might get normally. So both the risk and the cost of capital on the debt will go up. How does the risk and cost of capital of the equity depend on the firm's leverage ratio? Does it go up or does it go down? So the firm takes on more debt. What is happening to the risk of the equity? Is it becoming safer or is it becoming less safe? And remember, less safe claims, less safe equity requires higher costs of capital. So does the risk and cost of capital of the equity go up or go down?
Please pause this video now, answer the question on a piece of paper, and then continue.
Both the risk and the cost of capital of the equity go up. In fact, you could see this comparing Scheme 1 and Scheme 2 that we had before. You could see Scheme 1 as being 100% equity, no leverage, and then Scheme 2 having 85%, 86%, some very high number of debt. And what we saw is that the risk and the cost of capital to the equity were much higher. Now, if the cost of capital and the risk of equity goes up, and the cost of capital and risk of the debt goes up, and the firm consists only of debt and equity, does this mean that the cost of capital and the risk of the firm go up?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, the risk of the firm has not changed. The risk of the firm is still the risk of its underlying cash flows, which is 3/4 times sun plus 1/4 times hurricane. But how can this be? Both of the constituents are actually going up in risk and cost of capital. And the answer is that as you change the leverage ratio, you're not changing only the cost of capitals, you're also changing the mix between the two terms in the sum. So as you change the weight on the debt, as you increase the debt, relatively more of the firm is financed with the debt, and the debt has a lower cost of capital. And that's the reason why the overall firm risk and cost of capital of the firm can remain unchanged. This is the key insight of capital structure. It doesn't really matter that the risk and the cost of capital of debt or equity or both, well, usually both, go up as you are more levered. It does not mean the risk of the overall firm or the cost of capital of the overall firm have to change. In a perfect capital market, they do not change. Here is a graph that tries to give this in an example that doesn't simply have 3/4 times sun plus 1/4 times hurricane. This here is an example where you have normally distributed payoffs. And what you can see is the debt ratio is on the x-axis, the rate of return is on the y-axis. As the firm begins right about here, so it has almost no debt, the equity is virtually the entire firm. So the weighted average cost of capital is going to be 20%. You are basically the entire firm. As the firm takes more and more leverage, that is, we move further to the right, the equity becomes riskier and riskier and riskier. The bond becomes riskier and riskier and riskier. But you know what? Almost not at all, because at this point, it's still very, very close to risk-free. You go further, 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 the equity becomes riskier and riskier, and at some point has to offer already 60, 70, 80% expected rate of return. And eventually the bond has to offer a higher promised rate of return. But of course, under those circumstances, what it promises is not necessarily what you expect to get. So the expected number is a little bit lower. But whenever you then take the weighted average cost of capital of this and this, out comes this one here. Out comes a weighted average cost of capital that's always 20%. So capital structure is irrelevant in a perfect capital market. This is also called a Modigliani-Miller world, which is after two of the guys that made a nice theorem out of it and more or less discovered it, maybe not the first time. Some people still argue about this, but it certainly has changed the world of finance when they put all their analysis behind it. So the next question that we will ask is, how does an imperfect capital market change the situation and render one capital structure better than another? That's it for this video, for chapter 17 and for all the basics of capital structure. You now know that all the many choices that I showed you in the previous chapter may not be important at all for large publicly traded firms that exist as if they operate in a perfect capital market. This is not the case for all firms. So in the next chapter, we'll take away the perfect capital market assumption, and then capital structure can matter. Then you can create or destroy value by choosing a capital structure that's not the best. That's when you can get inferior structures. So, see you soon. Bis bald.
Westwood Savings and Loan, how can I help you?
Hi, I'd like to borrow $1 billion to buy a company.
$1 billion? What kind of collateral do you have?
Collateral? I was planning to use the company's own assets to secure the loan. It's called a leveraged buyout.
So let me get this straight. You want to borrow money from the bank, use it to buy a company, then make that company take out loans to pay for its own purchase, saddling it with a ton of debt.
Exactly. The beauty is, if it all blows up, it's the company that goes bankrupt, not me. I've already collected millions in fees. Leverage is a beautiful thing, my friend.
I'm not sure I should be enabling this, but what the heck, everybody else is doing it. Just promise me one thing.
And what's that?
Don't buy this bank.